All too often, silver is seen as the bridesmaid to gold's blushing bride, but is this a fair reflection of the incredible metal? No, it's not, says today's guest. Author and investment editor Peter Krauth believes we'll start to see silver outperform gold in a dramatic way in the near future, and even touch $300 an ounce. He's so confident about the precious industrial metal that he's written a book about it. The Great Silver Bull. The best-selling book is a worthy read, but we were lucky enough to get some time with Peter himself to discuss the current silver price and why his expectations are so high. If you enjoy listening to our chat with Peter, then be sure to click subscribe and let us know what you think, either in the comments below or tweet us at Goldcore. We'd love to hear from you, and don't forget to grab a coffee and watch our new flagship show, the M3 Report, where we discuss the economy, precious metals, and bring you exclusive insights from experts around the globe. But don't dash off just yet. First, enjoy this interview with the best-selling author and silver expert, Peter Krauth. Peter Krauth, welcome to Goldcore TV.
Dave, thanks for having me. I'm glad to be here.
You're very welcome. You're very welcome. Now, literally, when it comes to silver, you've literally written the book, and the book is The Great Silver Bull: Crush Inflation and Profit as the Dollar Dies. We're seeing the dollar at the moment fairly much soaring against most other currencies. What is it that you're seeing? What's your take on the current situation that convinces you that this is only a temporary rally in the dollar and that it is set for a fall?
So, I would be guessing, of course, as would anybody, but if you look at, say, the last 30 years or so, the dollar index has peaked multiple times, but each time at a lower level. And I think that the current high could very well be sort of this most recent peak in the height of the dollar. It's being, of course, driven up by rate increases by the Fed. Naturally, people are flocking to the dollar because rate increases push up the value, push up payouts on near-term bonds, short-term bonds. But I think if you look at the longer term, the Fed really is trapped. If you look at things like debt levels, which are just off the charts as far as governments, businesses, consumers, students, car loans, all of it is really off the charts. And so the Fed can talk tough. The Fed will talk tough. I think that we are very close to perhaps a peak in rate hikes. Perhaps the next one or one more will be the last, in fact, of the rate hikes. And after that, once the Fed realizes that it really can't go further, recession likely being the reason for that, they will back off, either stop or, as I say, start to pull back and start cutting rates from a relatively low level, perhaps 3%. What will happen is that, and really they can't raise rates much beyond that. With debt so high, they know that for the government and for businesses and for consumers to actually be able to service their debts becomes impossible at rates that are too high. So as I say, they'll talk tough. They'll try to anchor our expectations to their ability to fight inflation, but in fact, their ability is very limited. Rates will peak relatively soon, and inflation will continue to run hot. And to be frank, it actually suits their purposes. It suits their needs to have inflation run hot, because the higher inflation is real inflation, the easier it is to pay back debts over the longer term, because debts are contracted at one level and they're paid back in much, much cheaper currency over time. So I think that's really how we can expect things to play out.
So the Fed's very much kind of caught between this rock and a hard place, between trying to tackle inflation and avoid a recession, and it's a very thin line that they probably can't walk. When we had inflation at these heights before, we had Paul Volcker in the chair, and you're suggesting then that they can probably talk like Paul Volcker, but they can't walk like Paul Volcker. Is that it?
That's exactly right. I mean, if you look at what happened in the 1970s, obviously things are always rather different, but comparable. So the 70s is the best analog that we have for the kind of period that we're in now. We lived through stagflation. Economic growth was flat or anemic, and inflation kept running higher. So I think we have, in that sense, the closest analog to what we have today. The big difference, and the difference that will make things worse and exacerbate the situation this time around, is debt to GDP. So in the 1970s, and I write about this in the book, there's a chapter that deals with that. In the 1970s, the debt to GDP in the US was actually falling, and by 1980 had reached 30%. So Volcker had the ability to raise rates because paying or servicing your debts at much higher interest rates when debts are relatively low becomes doable, even if it's for a short period of time. Today, the debt to GDP ratio is at 130% in the US. So more than 4 times what it was in the 1970s. So this is really, if you think about it, that's where how it boils down to for me, to come to the conclusion that the Fed can talk tough, but really can't act tough. It cannot raise rates sufficiently at something like, say, 3% or a little bit higher. The US would be allocating close to about a quarter of its annual revenues towards paying the interest on its debt. Wow. And so that's going to sacrifice all kinds of other programs, which is really not very popular. Or keep printing to be able to manage and continue to do everything and provide all the goodies that are promised during election seasons.
So no matter what it is that the Fed are saying, they've obviously got both eyes looking at the future, and they must be seriously worried about not just a recession, but the depth of a recession. We could have a serious recession here, and they must know that at this stage.
Oh, I'm sure that they do. And I think that's why they're so anxious to try to raise rates, raise them. Admittedly, they've been late at it. They've said so themselves. Now, having been late at it, they're trying to catch up. So they're raising rates at a considerable pace, at a considerable rate. So in other words, relatively high rate hikes over a relatively short period of time. So that's what's getting the market to freak out. But they realize that it's one of the few things that they really can do right now, because once recession kicks in, one of the few tools they have is to start cutting rates. And if they haven't really raised them very much, there won't be much cutting that they can do. And so that's part of the trap that they're stuck in.
That always kind of reminds me of the idea of hitting yourself over the head with a hammer because you like how it feels when it stops. But that said, do you think that they're now trying to increase rates at a fast pace in order to get a reaction from the market, or to influence inflation in the short term, so that they have an excuse to say we can calm down now?
Yes, absolutely. I think they feel like they need to try and get ahead of the market a little bit to signal that, obviously, at 9.1%, which is the latest print in the US for June, inflation is much too hot, and they want to signal that they're doing what they can to get it under control, and that they have every intention of getting it under control. And so I think if you look at the reaction in the stock markets and in the bond markets, and to some extent to commodities, precious metals included, we've seen the reaction to that, I should say. All of these assets are down somewhat, but it's very interesting to note that gold is nearly flat on the year. Commodities, if you look at a commodity index, for a broad commodity index, for example, as little as a month ago, commodities were up 44% just this year, and in the past month have backed off and are still up about 22%. So it's a huge gap between how much commodities are up since the start of the year and how much the S&P and bonds are down. The S&P is down 20%. 20-year treasuries are down 20%. So that's over 40% gap between commodities after the correction in commodities over the past month and what the S&P and bonds have done. So, I think that as investors start getting their investment statements in the mail after each quarter and are looking at what's happening to their mutual funds and their bond funds, and they're saying, wow, this is crazy. Bonds should not be down 20%. I didn't invest in bonds to lose this much in 6 months. What's going on? And I think people really will start realizing they need to look at alternatives. And hopefully some savvy investors will do some research and realize the kind of environment that we're in and what performs well in this kind of environment. And it's clearly commodities and precious metals. It really is hard assets, and investors absolutely must take a very close look at that.
Crush inflation and profit as the dollar dies. As we said, like, the dollar has been on a run there for a while, but there is this worry about what will happen when the Fed do a 180. And probably driven by the fact that the U.S. economy is showing a significant decline. It's a difficult argument at this moment in time to make to a lot of people to be investing in silver, because they've seen what's happened to silver over the last couple of months and the pressure that it has been under. But that's all very short term. From a long-term fundamental point of view, what is it that underpins your bullishness in silver?
So there are two main drivers for silvers. About half of silver, 54% to be exact, is used for industrial purposes. And the biggest ones of those are things like solar panels, electric vehicles, electronics and electrical applications, medical applications. It's actually a fantastic biocide that was discovered centuries or millennia ago. So silver has a lot of industrial applications, and you could argue that the other 50% of silver use is some sort of investment. That's a mixture between actual investment, things like silverware, jewelry, and so on. So really, you could argue, as I say, that those are mostly investments of some sort. I think both of those two main allocations in terms of silver demand, industrial and investment, are actually going to help support silver medium to longer term. It costs about $18 US an ounce all in to mine an ounce of silver. We're right about that price right now. I was asked recently, if silver continues to back off, at what point should you buy? And I said, to me, $18, because it's obvious that it can always spike a little bit lower. I think that would be temporary if it made it to 17, for example. But anything below the production cost means that producers are going to start to back off and start to pull back on supply. So I think that the industrial demand, because it's so solid and because of this trend towards this long-term trend towards green energy and this green revolution, et cetera, is pushing demand for silver. As I said, silver is big in things like EVs and solar panels. And to give you just one example, so the single biggest use on the industrial side for silver is solar panels. 11% of all the silver that is supplied every year goes into solar panels. And the International Energy Agency has a forecast that by 2030, the output of electricity from solar will be up 8.5 times. So the math is actually quite simple. If right now solar takes 11% of all of the silver supply annually, and solar output is supposed to be up by 8.5 times in 8 years, solar would potentially consume all of the silver supply every year within 8 years. So as you and I know, that's highly unlikely, but the market forces will react and push silver prices up to force perhaps solar panel manufacturers to look for ways to be more thrifty in the consumption and so on. But that's actually another discussion, because the coming technologies in solar actually look towards using even more silver to get a little bit more output, electrical output. So silver being about 20 grams of silver go into each solar panel roughly. So it's a relatively small cost to produce a solar panel. And so even if consumption were to go up 50%, let's say, which is actually what the next technology looks like, it will consume in terms of silver. It's unlikely that it's going to slow down or affect solar panel production. The contribution of cost from silver is just so low in the overall. And so that's very, very bullish. I think that industrial demand will help keep a floor under silver prices. And it's going to be the investment demand that's going to be the sort of wild card that when people realize that the Fed has basically blinked, has stopped increasing rates because it's seeing what it's doing to both the economy and the ability for people to service businesses, and government to service their debt. I think that's when all bets are off. And we're probably only a matter of months away from that. And that very likely will kick off a very big rally and bull run in the precious metals. And so that's where I see investment demand kicking in on the silver side and really pushing it much, much higher.
That solar story that you're talking there is a very interesting one, and is going to have obviously huge implications for the market. But the market is also currently in deficit at the moment, isn't that correct?
Right. That's right. Exactly. In 2021, there was about a 50 million ounce deficit. This year, it's forecast by the Silver Institute to be about a 70 million ounce deficit, and they forecast deficits in silver supply versus demand over the next several years. So there are a lot of really strong supportive drivers for silver. There's really no question about that when you look very carefully at the numbers.
So we've got a situation, we've got a market that's in deficit. We've got a big solar story here that is going to be heavily weighing on the demand side of things. We've also got that the fact that silver is currently trading at or near the all-in cost of production. Why do you believe that, given everything that's going on in the market at the moment, that we're actually seeing silver down at these levels?
I think that it's a little bit like what we're seeing in commodities and in stocks and in bonds and in gold. When people become afraid, they start to sell. And they sell things that are up the most. Stocks and bonds were up the most. There's no question about that, especially if you look up until the end of 2021. And then from there, they look at other things in their portfolios that are up, perhaps less so, and start selling those as they need to, need or want to move towards cash. And so that helps to explain how these different assets, stocks, bonds, commodities, precious metals, have either, in the case of gold, remained flat, in the case of the others, pulled back somewhat, and the dollar has risen. So I believe that's a temporary situation. People are flocking to the safe haven of the dollar. It certainly helps that higher rates make the dollar more attractive. It pays a better rate of interest. And so investors have sold other assets, at least temporarily, to go towards the safe haven being the dollar.
Now, with Goldcore, we don't like to make price predictions. We see precious metals very much as that insurance aspect of your portfolio. But in your book, you talk about a long-term, and I stress here, a long-term price target for silver of $300 potentially. That's over that's huge increase on where we are now. What is that based on, that long-term prediction?
So I've been looking at multiple indicators and researching this for many years. In fact, one of the perhaps best understood and most known indicators is the gold-silver ratio. And what you need to do is pick a number for where you see gold going. And if I look at my own predictions going back over a decade, I've said gold will eventually reach at least $5,000, as a peak price. Mm-hmm. And frankly, that was 10 years ago. Given how things have played out so far in terms of debt, tripling or quadrupling or more of balance sheet. The amount of money that's been printed by central banks is really off the charts. And I ultimately think gold that can easily reach, in fact, more like $10,000. And in my defense, I'm not the only one who thinks that. Your viewers might recognize names like Jim Rickards or Scott Minerd, Shane McGuire, who runs the Gold Fund for the Texas Teachers Retirement System. We've also got Incrementum. There's an In Gold We Trust report that's written by Ronnie Stoferle and Mark Valek every year, which is really a Bible in terms of gold research. And each of these has an ultimate target in gold that, and they get to their numbers a different way, each their own way, which is also interesting and impressive to me, of $10,000. So let's take two of these numbers. If I use, first, let's go back to the 1970s. That's the best analog that we have. So in the 1970s, or at the end of the 70s in 1980, in January, when silver peaked at $50, the gold to silver ratio bottomed at 15. So the gold silver ratio is essentially how many silver ounces it takes to buy a gold ounce at the given price for both of those metals at that point in time. So silver at $50 only required 15 ounces to buy gold in 1980 at the peak. If we were to take that same bottom in the ratio with a gold price of 5,000, then that would give you $333 in silver. So I averaged down a little bit to 300. If you take 10,000 in gold and you go at half of that ratio, which I believe is the point, if the ratio eventually falls to about 30, there's no reason why the ratio has to absolutely fall down to 15 the way it did in 1980. So let's be a little bit more conservative and say the ratio falls to 30. So at $10,000 gold, at a 30-to-1 ratio, you're still at $333 silver. So, and I have other indicators that when I did the work, actually all ended up pointing to some range around $300. And so that became significant for me. And I said, and to be fair, I'm not saying it has to go there, and I'm not saying it'll go there and stay there, but I do believe that there's a strong possibility that in a speculative mania that silver could absolutely run up to $300 level. It's amazing what the fear of missing out will do. Silver is a very volatile metal. It is very much driven by sentiment, and we saw that. I believe that was a lot of what happened in the 1970s, and to some extent when it again peaked near $50 in 2011. But these are things that suggest what can happen in silver. And absolutely, I think, it's something that for investors need to be positioned for to try and take advantage of. And at $18 right now, I don't think your upside is going to get much better than it is at this point in time between 18 and 300. So it's really looking like an attractive time to at least dabble in this space.
What was it that first got you interested in silver?
So I've been investing, researching, and writing about silver for over 20 years. My dad was actually the first one who introduced me to, I guess, looking at research and information that was, I guess you'd say, outside of the mainstream. And so I paid attention when I saw what happened in 1980. And then it wasn't until I'd say the early mid 2000s that I started to get more seriously involved in silver. I saw that it had bottomed at about $4 in 2001, and it really started to pick up. And so as I say, about 20 years ago, I got more involved, but really kicked things off for me. And I've been researching and writing about it for the last 15 years, involved in investing for 20. But in 2020, when I saw what happened in silver and in gold, when the pandemic hit, silver went from about $18 to $12 within a matter of weeks, but then from $12 to $30 within the next 5 months. That was about 150% return. And in that same time frame, gold did about 40%. So silver outperformed gold almost 4-to-1 within 5 months. And again, based on my research, when you see silver start to outperform gold in a dramatic way, it tends to indicate that you're approaching sort of the acceleration phase in the precious metals bull market, and that it's likely over time that silver will continue to outperform gold. And so, you know, gold is absolutely something you'd want to be invested in and have in your portfolio. I just think that the upside potential in silver is so tremendous that it needs to be something that people have exposure to. And I'm the first one to say it, and I describe all of that. I go into all of those details in the book about how silver is volatile. And but because it's volatile, that becomes an advantage, especially to the smaller retail investor. You can use that volatility to benefit you. And you can also manage the risk that comes with that volatility by limiting your exposure. You can have smaller allocations to whether it's physical silver or to silver stocks, and you can play with the volatility. And when you see that things have run up considerably, take some money off the table, sell a portion of your investment, lock in some of those gains. And when you see a situation like we have right now, where the stocks have sold off, the metal has sold off, it's definitely time to dip your toe in and start making at least gradual allocations. So I really believe that silver volatility is not something that people should use that as an excuse to shy away from the metal and its investments. It should be an attraction. And again, I talk about in the book how to really manage all of that. It's really not that difficult. A lot of it is very, very common sense.
Before we wrap up here then, Peter, where can people find out more about what it is that you offer, and also where they can find the book?
Well, thanks. So the book, The Great Silver Bull, is available on Amazon. You just need to go there, type it in your search bar. You have it available as a paperback and in Kindle version. And other than that, I write a silver-focused newsletter that is exclusively about silver. It covers everything from physical silver all the way to junior explorers and everything in between, things like royalty companies, silver, physically backed silver ETFs and silver miner ETFs, royalty companies, producers, mid-tier producers, and explorers. So that's called Silver Stock Investor, and you can find more information about that at silverstockinvestor.com. I'm also on Twitter and on LinkedIn, and so people can certainly find me there as well.
Super. Well, what I'll do is I'm going to put a link to your website and your Twitter handle in the description, the show notes below this video. But for now, Peter Krauth, thank you for joining us on Goldcore TV.
Dave, it's been my pleasure, and I look forward to chatting again.
Indeed. My thanks to Peter Krauth for joining us on Goldcore TV. As we mentioned, you can find out more about him in the description below this video, and be sure to check out his book, The Great Silver Bull. There's a good reason why it's a bestseller. If you enjoyed listening to this in-depth chat about silver, then why not subscribe to Goldcore TV and check out our interview with the silver guru himself, David Morgan. He joins us on the M3 Report, our new flagship show, and it's an interview that you don't want to miss. For David, our society cannot survive without silver, and it is pertinent to our future. We discuss this as well as the future of our monetary system. Also on the M3 Report, we have commentary from our own team, plus Chart Watch with the chart man himself, Mr. Garrett Soloway. And don't forget, if you have been affected by any of the issues in this program and are being overcome with the desire to buy silver, then please head over to goldcore.com, where a quick sign up or a chat with one of my colleagues will have you all set with silver bullion and feeling better in no time. Thanks for watching.